Hi, hope everybody's doing well and welcome back to the channel. If you're new here and enjoy this video, please drop it a like, leave a comment and subscribe to the channel. Today's video is based on 4 growth companies that I have over £10,000 worth invested in. And as you can imagine, these are companies that I always keep a close eye on, especially around earnings season, to see their earnings report and to see if my bull case for each of these companies is still intact. We'll go through some of the extracts from each of these companies to see if we can make heads or tails from the earnings reports. First one we'll take a look at is Palantir, who out of all the other companies had by far the best quarter out of the 4 stocks, and they smashed it on all fronts. Earnings per share exceeded, revenue exceeded, adjusted operating margin exceeded, and one of the areas where people were really keen to take a look at is the commercial growth side of things. And within the US, this was up 90%, which is a huge number. They closed an impressive amount of deals varying in size from $1 million to $10 million plus dollars, and they also raised guidance, which, if there's one thing we know about the stock market, is it's always looking ahead. So let's take a look from the top down and see if it's all as rosy as it seems. Q2 revenue up 49% year over year, and the first half of the year mirrored that percentage gain with again another 49%, bringing in the first half revenue up to $717 million. First half free cash flow found itself in the green by $201 million, where it was in the red by $232 million this time last year. The next part is really quite astounding, as they raised full year cash flow guidance from $150 million to $300 plus million, which is just absolutely crazy. To raise this by 100% shows the confidence within the company that they have for the remainder of the year. Operating margin increased from $29 million up to $117 million, with an operating margin of greater than 30%, which is for the third straight quarter. Total contract value booked up a huge 175% to $925 million, and billings are up 40% to $379 million. And they also added 20 net new customers in 2021, which is up 13% quarter over quarter. Revenue grew 49% up to $376 million, which is up from previous guidance, which they had around 43%. And as you may know, Palantir has a lot of contracts with various governments, which has formed the foundation of their business model. And as they now expand to get into the commercial market, the government contract revenue is still up 66%. As we said, US commercial growth was up 90%, and overall commercial revenue was up 28% from $112 million to $144 million. New deals came in at a staggering $3.4 billion, which is up 63%, and as we can see, we have a good amount of deals which are ranging in size from $1 million to over $10 million. Average revenue per customer is up 19%, but the average revenue for the top 20 customers is up 36%, which tells me that the big customers who are with Palantir are willing to pay big for their service. First half free cash flow has done a 180 flip from negative $232 million to positive $201 million, and a very healthy margin of 28%. Guidance for the rest of the year is $385 million with an operating margin of 22%, free cash flow of $300 million, which as we said is up 100% from the initial guidance of $150 million, and finally the long-term outlook of over 30% growth for the next 4 years. I don't know about you, but after reading the report, I think they've absolutely smashed it. And the only thing on my mind is, with these impressive numbers, is if they can keep it up going forward. You really get the feeling that this company is on the edge of something special. And the next stock we have is Airbnb, who had an excellent quarter, beating analyst expectation on both top and bottom lines. Adjusted EBITDA came in at $217 million, which is a huge jump up from the negative $397 million in Q2 last year, and is up from negative $43 million in Q2 2019, which is pre-pandemic levels. They also gave a very positive upbeat guidance report that they expect Q3 to be the best on record, but they did also highlight the risk of the Delta variant. Nights and experiences booked are up 197% at 83 million. Gross booking value is over 13 billion, which is up 320% year over year, and it's also beaten pre-COVID levels by 37%, which is a similar story in the revenue side of things, as this is up nearly 300% year on year and beating pre-COVID levels by 10%, coming in at 1.3 billion. I like the look of this, as travel isn't back to 100% and will likely take some time before we're beating pre-COVID levels, and it's a promising sign and a step in the right direction that the net loss is significantly improved, sitting at negative 68 million, and finally the adjusted EBITDA at 217 million. And the key information I'm taking from this section is the area highlighted where they mention that on all metrics they're beating pre-COVID levels, but at the same time net losses improved alongside positive adjusted EBITDA. And as we get back to being able to travel more freely, the cost savings that they've implemented during COVID alongside future revenue growth can set them up for a path back to profit. As Airbnb have a global footprint, let's take a look and see what they're saying on the booking side of things. North America showed continued strength, increasing about 25% above the level achieved in the same quarter of 2019. Europe, the Middle East and Africa have seen a big pickup in 85% since Q1 21, being led by UK, France, Spain and Italy. Latin America is up 15%, showing strength in Mexico and Brazil, with Asia Pacific, they're growing but they're still a bit under pressure, as at the moment these areas are still facing lockdown protocols and come in areas that rely heavily on cross-border travel. Looking at the financials graphically, it really paints an encouraging picture where the losses and adjusted EBITDA improving and the outlook for Q3 set to be the best quarter in the company's history. So that will be something we'll need to keep a close eye on, especially with the Delta variant kicking about. This Q2 report, in my opinion, had a lot of positives, noting that the recovery for travel is well underway and cleaning up on the financial side of things. I think it paints a real positive outlook for the company for the rest of the year and going forward. And now we're on to the Tattooed Chef, who missed earning expectations, resulting in a hefty sell-off. Revenue was up 46%, which if you look at this in isolation, is still pretty an impressive number, but with the expectations that analysts have of this high growth company, expectations fell short by 3.35 million. So let's dive into the facts and figures to see if it's as bad as the sell-off suggests it is. We'll start at the bottom, and as we said, revenue growth was up 46%, gross profit was 8 million, or a 15.7% gross margin, compared to 3.7 million or a 10.8% gross margin. So this is also a positive, but below that we see where the substantial net loss of 53.2 million comes from, and it's from a non-cash expense, a one-time payment of 46 million, resulting from a valuation allowance on a deferred tax asset due to investments. And although this is looking ugly straight off the bat, these one-time payments may spook investors, but the bull case still remains intact, as these shouldn't be happening very frequently within the next earnings reports. The second paragraph tells us that their business strategy and that they're exceeding the previous goals of being in 10,000 stores, where actually they're in over 12,000 stores, so that's another piece of positive information, and it's good to take a note of this. The section that I've highlighted shows where the future growth lies in the coming quarters, with more products coming out later this year and next year as they move into more refrigerated and ambient products. So for me, I think it's a bit of a mixed bag of the results. Obviously, you've got that hefty payment, which really is a bit of a grey cloud hanging over it. But moving forward, I think the long-term plan for this company still seems exciting. They still have 140 million in cash, which puts them in a strong position, and the outlook for the rest of the year is a 49% year-over-year growth from the base business. Adjusted EBITDA is still to be negative between 14 and 17 million, which they're justifying by mentioning this will be because the company are still following an aggressive growth strategy, with the top line growth being the main aim, and they're still being impacted by increased costs for logistics, storage fees and legal fees, as well as shortages within the packaging products. Capital expenditure to be between 15 and 20 million, and to summarise, in my personal opinion, I think the stock remains a buy at these low prices. It's still got a market cap of under 1.5 billion, and with expected top line growth over the next few years alongside a healthy balance sheet, I think this company should be a sound investment for the next few years and beyond. Earnings per share is always going to take a hit during these times where the high growth is the focus, but they've got enough capital and they've got innovative products coming out with the main aim to get the products on the shelves to help with brand recognition. So for me, I think it is a bit of a mixed bag, but yeah, long-term growth prospects for this company still seem well and truly intact for me. And the last one we've got here is Sofi. Same as the Tattooed Chef, Sofi missed on the bottom line, resulting in a sell-off within the stock. However, top line revenue came in at a huge growth of 74% at 237 million, beating expectations by 18.6 million. Members have continued to grow at an accelerated rate at 113%, which really is quite impressive. Products also growing at an accelerated rate at 123%, also really impressive. And the Galileo accounts have grown to 79 million, and they've had the last 4 quarters of over 100% growth. Sofi as a business have been trying to diversify their financial products, and when you see the growth rate from where it was in Q1 19 to where they sit just now, with quarter over quarter growth well into the triple digits, it's really quite a bullish indicator for me. Quarterly adjusted net revenue is up 74% year over year, and quarterly adjusted EBITDA has its fourth consecutive quarter of positive EBITDA and is up 39 million. Is up 35 million from a year ago. Annual performance shows consistent and impressive growth alongside an equally positive indicator of a path to profit shown by the year-over-year improvements being made on the annual adjusted EBITDA front. Q3 shows expected strong growth in a range between $245 million and $255 million, with an adjusted EBITDA to range between -7 million and +3 million. And this could be where the sell-off is coming from, as these numbers are below analyst expectations, which were around the 270 million mark, as well as the company mentioned the possibility of negative adjusted EBITDA of 7 million, which doesn't sound good in comparison to this month's or this quarter's report, where they had a positive EBITDA of 11.2 million. Full year guidance still paints a strong picture, with expectations of 980 million in revenue showing growth of 58%, and adjusted EBITDA expected to close out the year in the green with 27 million or a 3% EBITDA margin. So this sums up the video, guys. I hope that you found value in it, and as I said at the start of the video, all these 4 companies are owned by myself, and although there may be some short-term headwinds around some of the companies like Ttcf and Sofi, I still think, in my humble opinion, that the bull case remains intact in these companies, that any volatility to the downside, it could be a good buying opportunity. So yeah, thanks again for watching, guys. I'll catch up with you in the next video.